Welcome to the deep dive. Today we're going to be taking a deep dive into the world of stocks and the stock market.
Yeah.
We've got some fascinating material to go through from Professor Oz's introduction to finance notes.
Okay.
And a whole bunch of other kind of finance-focused excerpts.
Right.
And so we're going to be looking at what stocks are, how we even begin to figure out their value.
Yeah.
And the ongoing debate about just how efficient the market really is.
Yeah, it's amazing how, the stock market's this term that, most people are familiar with, but then, the actual workings of it can be pretty perplexing.
Oh, yeah.
So I think this deep dive will help clear up a lot of that for you.
Yeah, I think it's one of those things that everybody talks about, but I'm not sure everybody really knows what's going on.
Yeah.
So let's break it down. What exactly is a stock?
Okay, so a stock is basically like a piece of ownership in a company.
Okay.
It's as if you own a tiny fraction of your favorite pizza place or a tech giant or even an airline.
So if I buy a share of a company, can I dictate what kind of toppings they put on their pizzas?
Not exactly.
Okay.
While you become a part owner, you don't get to make all the decisions.
Got it.
It's more about participating in the company's journey.
Okay.
So if the company thrives and does well, the value of your shares increase. And conversely, if the company makes some questionable choices, the value could decrease.
Okay, that makes sense. But why would a company even want to sell pieces of themselves?
So that's where things get interesting.
Okay.
So companies often start as private entities, they're owned by a smaller group of investors.
Yeah.
But as they grow and as they aim for bigger ventures, they need more capital than those initial investors can provide.
Okay.
So that's when they might decide to go public.
Oh, so they go public as a way to raise funds.
Exactly.
To kind of expand even more.
Precisely. And that initial offering of shares to the public is called an IPO.
IPO.
Initial public offering.
Okay.
And these IPOs can be quite the events, sometimes exciting, sometimes chaotic. It just depends.
So now let's say a company decides to go public and I want to buy a piece of it.
Okay.
How do we even determine what it's worth?
Right. That's the million-dollar question, quite literally.
Yeah.
So valuing a stock, it's more of an art than a science.
Okay.
But there are two main methods that are used by analysts.
Okay.
The first is discounted cash flow analysis, or DCF.
Okay.
And the second is relative valuation.
Gotcha.
So these are pretty sophisticated terms, but let me break them down for you.
Please.
So think of DCF analysis like a financial time machine.
Okay.
What we do is we predict all the future cash flows that a company will generate.
Oh, wow.
And then we discount those cash flows back to the present value.
Hmm.
So it's a powerful tool, but it's heavily reliant on assumptions about the future.
Yeah, for sure.
And even slight adjustments to those assumptions can lead to vastly different valuations.
Right. So DCF is like gazing into a crystal ball and try to figure out all those different what ifs.
Exactly.
Okay. So what about relative valuation? What is that?
So relative valuation is more like comparing notes with your neighbors.
All right.
So instead of predicting the future, you look at similar companies.
Okay.
To understand their worth.
So kind of like, if a pizza place down the street sells a slice for $5.
Yeah.
And this pizza place is comparable.
Right.
Their slice should also be worth $5.
That's a simplified way to put it, but you've got the idea.
Yeah.
And this is done by utilizing multiples.
Multiples.
And the most common multiple is the price to earnings ratio, or PE ratio.
Okay.
So what you do is you compare a company's price to its earnings.
Right.
And then you see how that measures up against its peers.
So DCF is about predicting the future. Relative valuation is about checking out what's happening around us.
Exactly.
Okay.
And both approaches have their pros and cons.
Right.
DCF can be more theoretically sound, but as I mentioned, it's really sensitive to those assumptions.
Wow.
While relative valuation is easier to implement, but it hinges on picking the right neighbors for comparison.
All right, so you got to make sure you're comparing apples to apples.
Exactly.
Now, with DCF, you mentioned predicting future cash flows.
Yeah.
How do you even begin to do that?
So it's quite a process.
I bet.
But it starts with analyzing the cash flow that is available to all investors in the company, not just stockholders.
Okay.
And this is called free cash flow to the firm, or FCFF.
FCFF.
And it's crucial because FCFF represents the actual cash a business generates,
Okay.
irrespective of its financing structure.
So that's the real deal, the cash they actually have in hand.
Exactly. So we project this FCFF for a set number of years,
Okay.
say 5 or 10,
Right.
and then we estimate the terminal value, which
Right.
represents the value of all cash flows beyond those projected years.
Gotcha.
And there are two primary ways to do that. You can either assume a perpetual growth rate for the company or use an exit multiple based on the valuation of comparable companies.
Wow, predicting cash flows years into the future and terminal values and exit multiples.
Yeah.
Seems like there's a lot of room for error here.
Oh, you're absolutely right.
Yeah.
And that's why sensitivity analysis is crucial in DCF.
Okay.
So we test various assumptions to understand their impact on the valuation.
So what if the growth rate is lower than we projected? Or what if interest rates go up?
Right.
So even with a method as sophisticated as DCF, there's a degree of uncertainty.
Absolutely.
Okay, well, speaking of uncertainty, let's move into this concept of market efficiency.
Oh, that's a great segue.
Yeah.
So the efficient market hypothesis, or EMH, argues that stock prices already reflect all known information.
Okay.
So the market is considered to be so adept at processing information that consistently finding mispriced stocks is nearly impossible.
So if I think I found a bargain,
yeah,
EMH would suggest I'm missing something.
It's more likely that you might have overlooked some crucial information. Or your analysis has some flaws.
Okay.
You know, think about it. Thousands of intelligent and well-resourced investors are constantly analyzing stocks. So if there was like an easy way to beat the market, everyone would be doing it.
Yeah, that's mind-boggling.
Yeah.
So what makes the market so efficient?
So firstly, there are these sophisticated investors that we mentioned.
Oh.
You know, the hedge funds, mutual funds, pension funds.
Right.
They are constantly on the lookout for any mispricing to capitalize on.
Right.
Secondly, trading costs are remarkably low these days.
Oh, okay.
Which allows prices to adjust really rapidly.
Okay.
And finally, the markets are incredibly liquid.
Liquid.
Meaning you can buy and sell vast amounts of stock without significantly impacting the price.
Okay, so it's like trying to outsmart a supercomputer in a game of chess.
That's a great analogy.
Yeah.
And there's evidence to support this notion.
Okay.
So studies reveal that stock prices react almost instantaneously to news, whether it's positive or negative.
Wow.
For instance, a company's stock price could surge within seconds of a positive earnings announcement.
That's incredible.
It's amazing.
They process information faster than I can order a pizza.
What other evidence is there that suggests that the markets are this efficient?
So there's a rather striking statistic.
Okay.
Over a 10-year period, 91% of actively managed U.S. stock funds underperformed the S&P 500 index.
Wow.
Yeah, in fact, only 2.2% of the top-performing funds maintained their position in the top quartile for 2 consecutive years.
Wow, so even professionals with all their resources and algorithms still struggle to beat the market.
That's exactly what the evidence indicates.
Wow.
It's a humbling realization for anyone who thinks they can easily predict the market's every move.
It's so much for those stock-picking gurus we see on TV.
Right.
But if the market is this efficient, does that mean stock prices are always accurate?
So hold on there. Market efficiency doesn't necessarily imply that prices are always perfectly accurate.
Okay.
It simply means that consistently identifying and exploiting any mispricing is very challenging.
Okay.
Prices can and do change when new information comes to light.
Okay, so it's not a completely random game of chance.
Yeah.
There's logic behind these price movements.
Right. But why do stock prices fluctuate so much, sometimes even within a single day?
So remember our DCF model?
Yes.
Well, stock prices change for 2 primary reasons. Either investors' expectations regarding future cash flows shift or the discount rate changes.
Okay. Can you give us some real-world examples of what might cause those expectations or the discount rate to change?
Sure. So let's say a company unveils a groundbreaking new product that's poised to take the market by storm.
Yeah.
Investors would likely become more optimistic, revise their expectations for future cash flows upwards, and the stock price would probably rise in response.
Okay. And what about the opposite scenario? What if a company announces some bad news? How would that affect the stock price?
So imagine a company issues a major product recall or faces a scandal involving its CEO.
Right.
These events could tarnish the company's reputation and potentially hurt its future sales.
Right.
So investors might lower their cash flow expectations, causing the stock price to drop.
So any news that impacts a company's future earning potential can really send ripples through the stock price.
Exactly.
Okay. What about changes in the discount rate? What might cause that to happen?
So the discount rate is influenced by factors like interest rates and risk perception.
Okay.
So for instance, if the Federal Reserve decides to raise interest rates, other investments like bonds become more attractive.
Because you can earn a higher return without taking as much risk.
Precisely so. For stocks to remain competitive, they need to offer a higher return as well, which often means their prices need to adjust downward.
Okay, so higher interest rates generally correlate with lower stock prices.
Right.
What about this risk perception you mentioned?
So risk perception is all about how risky investors view a particular company or the market as a whole.
Okay.
If an event occurs that heightens this perceived risk, investors will demand a greater return to compensate for that risk, which can push stock prices down.
Okay, can you give us an example of something that might make investors perceive greater risk in the market?
Consider a situation where there's significant political instability in a country where a company operates, or like a global pandemic.
Right.
That disrupts supply chains and throws the economy into turmoil.
Yeah.
Such events would undoubtedly increase risk perception, leading investors to potentially sell off stocks, driving prices lower.
So there are all these factors constantly kind of interacting and influencing stock prices.
Yeah.
Which I guess explains why the market can be so volatile.
Right.
Sometimes even seemingly minor news can create like a ripple effect.
It's true. And that unpredictability is part of what makes the stock market so captivating.
Yeah.
And at times so frustrating.
It's definitely a lot to process.
Yeah.
We've covered so much ground already.
We have.
From like understanding what a stock actually is.
Right.
To the complexities of valuation methods.
Yeah.
And market efficiency, and even how those stock prices can swing wildly based on various factors.
Yeah, and we've only just begun.
We need to take a quick breather here, listeners.
Yeah.
Don't go anywhere. Because in part 2 of this deep dive, we'll be exploring even more fascinating insights.
Yes.
Into the world of stocks and the stock market. We'll be back in a flash.
Looking forward to it.